do not pull out of the stock market just yet. Now, while the economy continues to suffer and there's worries over a second wave, they're running rampant, the markets are screaming red hot and there's a lot of money to be made. And in this video, I'm going to discuss what is causing the markets to push higher, how long it could last, how high it could go, and how we can play this without getting wiped out when it finally crashes. So stay tuned. Welcome back to the channel. My name is Mark Moss. On this channel, I like to talk about making money. We like to talk about investing money. We like to talk about just having overall success in life. So if you like those topics, which I'm sure you do, click on the like button right now so more people see the videos, and then also click on that subscribe button and the bell notifications so you're notified every single time I put more videos out. All right, now in this video, we're gonna talk about not getting out of the stock market yet because it is screaming hot. And as a matter of fact, we could potentially see 30,000 Dow, 5,000 S&P 500, $5,000 gold. Now, is that possible? Is it possible to see stocks go parabolic from here? I mean, with everything that we have going on. Now, I get it. I hear all the naysayers. I see all the comments. As you know, I try to respond to almost every single comment that comes down. So I see it all and I hear it all, right? But Mark, the pandemic. But Mark, millions of jobs, 50 million jobs are lost, record unemployment. Most of these jobs are never coming back. I get it. I hear it all the time. I respond to all those comments as well. So I get it. But here's the thing that you have to understand. A couple things. Markets operate on completely different time frames than you and I do. Markets are disconnected from the economy. Now, it's completely possible to see the economy going down while the markets are going up at the same time. The market and the economy are not the same thing. Now, to be fair, we can make a really strong argument for either way. I can argue this on either side. Plenty of reasons for the markets to be going up, not counting on the economy. And there's plenty of reasons for the market to go back down. Now, in this video, I'm going to be explaining why the markets are going to be going up in the near term, and I'll explain how long. I'm going to talk about how far they can be going up and how we make the most amount of money as it continues to run long. But I am going to do a follow-up video where I'm going to look at why it could go down, how far it could go down, and most importantly, how we get out before the crash happens. All right. And then how can we lock in the profits before it crashes? So in this video, we're going to talk about the market going up, how we can stay in, how we can make a bunch of money. In the next video, we're going to talk about what happens when it ends and how do we get out without being wiped out. Now, for every single video, we're going to discuss how to position ourselves, like I said, for the upside, how to position ourselves for the downside. There is a strategy. All right, there is a strategy. Now, it is impossible to time market tops and market bottoms, so I'm not saying that, but there is a strategy that you can follow to make sure you can maximize your profits, but also limit your risk on the downside. Now, if you don't want to stick around and you don't want to find out about it, you can download the cheat sheet. It's in the description right now. There's a free report. You can find out about that. And I am going to do a 1-hour training where I'm really going to go into depth and tell you exactly how to set your portfolio up so we can take advantage of the upside, but also be protected on the downside. But let's jump into it anyway. So let's jump into why are the markets pumping and what are we going to do about it? So if the markets are pumping, then I want to stay in. I want to stay in and I want to go along for the ride. As the markets continue to pump, we have the opportunity to make more money in a shorter amount of time than we've seen in the last decade, and probably more than we can even imagine. And it's actually pretty simple, all right? The markets are pumping because the Fed is printing money. Pretty simple. Now, I've made a lot of videos about it, so if you've been watching this channel, it should be no surprise. Now, as long as there's enough liquidity going into the market, then the markets can keep going up. Remember that markets stop going up when there's no more buyers. So if the Fed is going to continue to buy and the federal government gives stimulus money to the people and they continue to buy, well, then the market can keep going up, right? It only stops going up when there's no more buyers. So if the Feds are buying and you're buying, it's going to keep going up. And like I said, I've done many videos on this for the last year. I've been making videos. We call this the Fed put. Basically, we're betting with the Fed. And today, it's being aided not just by the Fed put, but now we have a government put, a government stimulus put, and we're going to add that on top of it. It magnifies it. We're going to see even more explosive movement. Now, we know, like I said, I've covered this many times, that the amount of the Fed and the amount of the government money that's being pumped in, I mean, trillions of dollars have been pumped in just a matter of months. You can see it here on this chart on the screen. And as you can see, the recovery snapped right back. So we kind of had this V-shaped recovery. It fell all the way down, one of the fastest crashes in history, followed directly by one of the best recoveries in history. It bounced right off of the bottom right as the stimulus package was announced, and then it continued to climb higher and higher as the stimulus continued to get delivered. So the Fed continued to buy up more bonds, continued to pump more liquidity into the market. At the same time, the stimulus was going to the people, the retail investors, and they were continuing to buy it back up. All right, now this was thanks to the CARES Act, which was the giant government stimulus, and it basically gave trillions of dollars funneled directly to people's bank accounts. All right, now if you're one of those people out of work that didn't get the money, I get it. It wasn't a lot of money. It definitely doesn't, well, for most people, it doesn't replace all of their income, and so they're left short. However, that being said, a really good chunk of this ended up back into the stock market. Now, we've seen this. I've done a video about this where basically the rise of the Robinhood investors is kind of what the media is calling it. Robinhood is a trading app. And all these people have been getting their stimulus money and putting it right back into the stock market. In the video, I talked about bankrupt companies like Hertz, bankrupt companies like JCPenney, and this is creating bubbles, and it's creating FOMO, fear of missing out. And so we have all these traders, a lot of them coming over from gambling because all sports are shut down. They're getting their stimulus money. They're not working, and they're buying stocks, creating bubbles, creating FOMO, and more people are jumping in. Now, there's a few reasons why I think that this can go on for much longer and much higher than most people think. Now, when we look at bubbles, when we study bubbles, we can see that the bubbles can climb for a long time. There's a famous quote, and it's either by Gary Schilling or John Maynard Keynes, I'm not exactly sure, but they said that, quote, "The markets can remain irrational longer than you can remain solvent." All right. So what that's really saying is, like, don't bet against the market, bet with the market. But the first part, it can remain irrational longer. So when you think the market should turn down at this point, it's irrational. It's acting irrational. People are acting irrational. The Fed's irrational. The government's irrational. The people getting the stimulus and the Robinhood traders, they're all irrational. And it can remain that way much longer than you think. All right. So let's look at a few reasons why the markets could continue much higher right from here. All right. I'm going to give you a couple really good reasons. So let's dive into that. So these reasons I think can drive the market higher than most people think. And just keep this in mind. Keep an open mind. I can already hear it, and I already addressed it, but the markets and the economy are not the same thing. All right. In fact, today, the markets and the economy are almost like inversely correlated, like they're moving opposite. So let's look at some of the catalysts why the market could keep going higher. So catalyst number one is more money. Right? More money. That's what drove the market higher. If we get more money, should drive the market higher. So we've already got trillions of dollars in stimulus. They've already been approved, but we haven't seen it all get to the markets yet. So we have previously passed stimulus funds, and they're still being delivered. As you can see on the chart, more and more money is still coming down the pipeline. And so, yes, some of the markets got here, but with a bigger chunk of the money still to come, that means potentially more of that money finding its way into the market. So what I expect is to see these new retail investors to keep pumping up the markets, to continue to push these bankrupt companies, insolvent companies, and so forth. And if more money isn't enough, how about more money again? All right. So the first round of stimulus, the CARES Act, got us this far, got us off the bottom. Well, just the announcement bounced us off the bottom. The CARES Act continued to push the market higher. But if you think that was pretty amazing, especially with the market going down, hold on to your hat, because there's a lot more coming from where that came from. So the Democrats have already approved a $3 trillion stimulus called the HEROES Act, and it's going to put a lot of money right back onto Main Street. When I say Main Street, I mean to you and me, into our pockets, and it includes more stimulus payments. It includes more stimulus payments up to $6,000 per household. It's going to extend the $600 per week for unemployment benefits all the way through January 2021. It's going to give mortgage and rent payment forgiveness or assistance. It has this Getting Back to Work Act, which is going to put a lot more money back into the street. And there's a lot more. I'm not going to go through everything. And they're even offering up to $4,000 for you to take a vacation as long as it's 50 miles or more away from your house. Now, I sure as heck could use a vacation. I don't know about you, but I would love to take $4,000 to go take a vacation. So it is going to create a lot of money, put a lot of money back in the markets. And I believe that a lot of money is going to get back into the stock market. Like I said, the first few trillion bounced us all the way off from the worst crash in history to where we are right now. So imagine what double that or triple that amount of money could do. Another 5 trillion or so. Imagine what that could do. And that's not it. It's like an infomercial, and that's not it. So we have more money. And again, we even have more money. So what am I talking about now? Well, we have another huge pile of money that's basically just sitting on the sidelines, and it's just waiting to be injected into the market. Now, this is not the Fed, but this is the federal government, and this time it's the Treasury. And the Treasury is sitting on a massive pile, over $1.5 trillion, that's sitting in an account ready to go, ready to be spent directly into the economy. Now, not through the Fed, not going through the markets, through the Treasury, and it could go directly to the people. Now, many analysts, including myself, think this could be spent back into the market right before the election. Now, I've talked about a couple times where kind of what I think, and I was expecting that we see a market dip before the election, and then it would be aggressively pursued by the Fed and the Fed government and pushed back higher. And so they could deploy this money, either one, to push the markets higher before the election, or two, just to prevent that next market crash. So we have more money, and now even more money. $1.5 trillion on top of the $3 trillion Heroes Act. So again, like I said, if you think it's unbelievable what the market did, just one of $2 trillion, imagine $5, $6, $8 trillion, because that is what we're going to see. So we have more money, and then we have more money again. And on top of that, we have new Federal Reserve policies. Now, what do I mean by that? Well, the Federal Reserve targets a 2% inflation rate. Problem is, they haven't been able to get that. We are seeing deflation, and they're fighting that. They're trying to pump more liquidity in the market, trying to get that inflation number. Now, I'm not a big fan of the Fed. I make that very clear in my videos. I don't think that trying to control the market is the right way. The market needs to be free, and I don't think it's even possible. So them trying to target that, it's just not possible. There's no way to nail 2% exactly, all right? There's no way to get it right. What the Fed does is they try to speed it up or they slow it down. And so as they're getting closer to their target, they start tapering down, and they try to kind of get there in a rough way, right? Well, the Philadelphia Federal Reserve President, Patrick Harker, said that they want to let the economy, quote, run hot, end quote. They want to let it run hot. So what are they saying? Well, they're basically saying until we get to 2%, we are going to let this sucker run. And so typically, like I said, what they would start doing is start tapering down so they don't overshoot 2% too much. Well, he's saying they're going to let it run hot until they get over the 2% target. Now, like I said, it's impossible to get this thing right. So if they're not going to taper down, they're going to let it run past 2%. I would believe that they are going to way overshoot their goal, and we are going to see a lot higher inflation. Now, when we have a lot higher inflation, that pushes asset prices up even higher, stocks specifically, and all the stuff in the market. So we have more money. We have Fed policies to overshoot the inflation target. And then we have the final catalyst that caps all this off and wraps it up into a beautiful bow. And that is FOMO, fear of missing out. And we're going to see FOMO, fear of missing out, from millions of people at the same time that are out of work, tens of millions of people that are all sitting around out of work. Now, bubbles work because of human psychology. I talk about humans make horrible investors because we're very emotional. Humans rush to pleasure. So we're really motivated by two things. We want to move away from pain, and we want to move towards pleasure. And so humans want to rush into pleasure, and so we chase gains, we chase profits. When a bubble's climbing and everybody's making money around us, then we want to make money. I want pleasure too, so I run in and I start buying, which then pushes it up even higher, which attracts more people, which pushes up higher. And it's like on and on and on. And so bubbles continue to climb, and then the bubbles climb the most at the top. At the top, more people, and it goes higher, higher, and higher before they finally come crashing down. They suck in more and more people until it's over, like that game of musical chairs or something like that. Now, as you have all these people, tens of millions of people at home with no job, but they're getting free government money. They're getting $6,000 a month. They don't have rent or mortgage payments. They're getting $4,000 to go on vacation, and everybody's getting rich in the stock market. guess what? They're going to want to get into the stock market too. They can't sit back and watch all the stocks continue to climb, everybody making all this money without them getting in. They don't have a job. They have a lot of time on their hands. They want to replace some of their income that they lost. They want to try and get lucky like everybody else, and they're going to jump in. Now, I know, I get it. The economy is in really bad shape. I get it. But knowing the markets and the economy are not the same thing. It's easy to see why the markets could continue to scream higher than we could ever imagine. Higher than we could ever imagine, and for longer than we could ever be imagining. So what should we do as investors that want to make profits, right? What do we want to do? Well, we got to stay in it to win it, all right? So as investors, the kind of overall rule of investing is you want to let your winners run long, and you got to cut your losers short, okay? So if the markets are winning, we got to let them win. We got to let them run longer. But how do we know when to get out? That's the question. How do we know when to get out? And knowing when to get out, it's impossible, right? Market timing does not work. We don't know when the bottom is, and we don't know where the top is until we're looking backwards at it, okay? So if that's the case, if I'm clearly saying that, how do we know how to get out in time? Well, there is a strategy that works for that, all right? And the strategy works 100% of the time. And it doesn't depend on being lucky. It just depends on you understanding what the strategy is and using it, all right? There's a certain way that we can set up our investments, a strategy where we can continue to see the upside in the market, but protect us from the downside and even profit from it. Now, I'm going to make part 2 of this video where I'm going to go deeper into that strategy. I'm also going to be doing a 1-hour training where I'm going to go in deep on how to set up your portfolio to maximize this. Think about like a basketball team, right? Where the basketball team has the offense and defense on the court at the same time. And that's how we want to set up our investments. Like I said, I'm gonna do an hour training. I'm gonna teach you all about it. And I'm gonna do a second part of this video. So check out the next video where I'm gonna talk about the case for it going down and what we should do to protect us from that. If you don't wanna wait around for the free training, you can get the cheat sheet that I have. There's a free report and it's linked in the description down below. And you can use it to understand what you need to do to set yourself up for maximum gains and protect yourself from risk of a massive crash, all right? Now, just one side note on top of this, when you see the stock prices going up, when I talk about gold going to 5,000, when I talk about the Dow 40,000 or whatever it is, that means inflation, right? All this money going into the market, it means inflation. And so what that means is that the dollar is losing its purchasing power. So inflation's going up and your dollar is buying less and less and less, which is all the more reason why you need to be investing, because you have to keep up with inflation. If you decide to sit out of this market, it could crash at any time, so I'm gonna stay out of it. I'm just gonna put my money in the bank account. You're gonna lose. You're gonna lose because of inflation, and so you need to be aware of that, all right? There's always risk. There's risks of being in the market. There's risks of not being in the market, and I just want you to know that. Now, leave me a comment and let me know what you think about this. Do you think that these 4 reasons are enough to keep the market going up higher? Or is the crash imminent and it's right around the corner? Let me know what you think in the comments down below. Give me a thumbs up on this video if you like it. If you don't like the video, it's okay, give me a thumbs down. Either way, let me know. Leave me a comment. Is it gonna go up or is it coming back down? And that's all I got for you right now. To your success, I'm out.